Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Yes, another video, back-to-back videos here. Why? Because I'm so far behind. I got to catch up. A lot of information out there, a lot of stuff going on in the marketplace here. And what I'm going to talk about today really is something for today's market, future buying opportunities, future investing opportunities, something I really put a lot of focus and effort on. So today's discussion is going to be based on foreclosures, what's happening in the foreclosure world in the marketplace. So that's a scoop. We're going to get into that right now. By the way, if you're not already a subscriber, please do me a favor, help my channel grow. Click the subscribe button at the bottom right of the video. I would really appreciate that. Also, if you're looking for more information on my turnkey investment strategy, short sales training, other real estate information, buying, selling, whatever in this area and other places, please drop me a line. Again, best way is to email me directly and include your telephone number, your cell phone, whatever, so I can text you. We can set up times to talk. There's a lot of stuff going on now. As I mentioned, I'm getting tons and tons of deals every day coming across my desk, which I evaluate. There's a lot of good opportunity there for people who are looking to invest in either fix and flip opportunities or cash flow investment, okay? And even some purchases. If you're looking to buy a primary home, maybe you'll take on a project if it makes sense for you. So definitely drop me a line and we can see how we can help you. I'm going to talk about my turnkey investment opportunity in a second as well too, please. So hang on, that'll be at the end of the video. So, excuse me, wanting to go over. And by the way, we're in our massive pollen months down here. If I'm coughing, it's not because I'm sick, it's because it's allergies. I mean, I take allergy medicine every day, but this is the time of year when all the green, dusty pollen settles on your house, your cars, so everywhere in the air, it's a mess. So just keep that in mind when you're in Florida. All right, so haven't talked about foreclosures in a long time. So guess what? Adam Data Solutions, which I do like as far as a data provider, they basically released their I guess you could say, what's it called here? They have a December or January report of the National Foreclosure Report. Okay, so the foreclosure starts decreased nationally, while REOs increased from a year ago. That's the tagline. There were 60,000 plus U.S. properties with foreclosure filings in January 2020, up 13% from December 2019, up 7% from up 13% from the December, this is talking January, and up 7% from a year ago from January 2019. So there you go. Basically, and this is where, again, the information is kind of not always clear here because we're just getting pieces of a report and some, writing about it. We've got, for me, I'm more concerned about foreclosure starts, which are filings, people who are falling into the foreclosure process. So ultimately, since the peak, okay, the value peak, we had all the foreclosure issues. We had, 10 million people filing, foreclosure filings. Every month there's been a decrease in value and number of filings. So that's a trend. So counter to the national trend, which is a decrease in monthly filings from way back when, 10 years ago, all right, or more, 19 states posted year-over-year increases in foreclosure starts, including California up 27%, Tennessee up 21%, Georgia up 14%, Illinois up 9%, and Ohio up 3%. So this is just sort of like some highlights right there. So 19 out of your 50 states are posting some decent increases in foreclosure filings. Also counter to the national trend, 75 of 220 metros analyzed post year-over-year increase in foreclosure starts, including San Antonio, 66%, Los Angeles, 63%, Riverside, California, 22%, Nashville, Tennessee, 19%, Chicago, up 14%. So now we talk of the states increasing. Now we look at some of the larger metros increasing as well. New Jersey, Delaware, Illinois, Maryland, and Ohio are the top 5 states with the worst foreclosure rates. What we mean by foreclosure rate is, it's 1 out of every X number of housing units. So, for example, New Jersey, the worst state in the nation for this, has 1 in every 1,046 housing units has a foreclosure filing. So they are the per capita, I guess you could say, winner for foreclosure filings. And there's reasons for that, of course, as all these locations. So just keep that in mind. But if you want to play in the investor game, there's a couple in New Jersey, Delaware, Illinois, Maryland, Ohio. States you should look at, of course, Florida as well too, where I'm down here. So anyway, excuse me, metros with at least 1 million people, the highest foreclosure rates were in Chicago, Cleveland, Philadelphia, Jacksonville, Florida, and Riverside, California. So there you go. So again, this is a sparse sort of synopsis of what Adam Data Solutions produces as a foreclosure report, which you have to purchase, and it's usually multiple $100s to get this report. So again, I don't buy it because I don't really play in these other markets. I work with Florida, and I can get the Florida stats pretty much on a monthly basis because it's available to me as what I do down here. So just that's why I know a bit more about that marketplace. Again, lenders repossessed about almost 21,000 properties in January, up 49% from the previous month, up 70% from a year ago following the holiday season. Now, why this is always a significant situation is the fact that if you are scheduled for a foreclosure sale during the holiday season, sometimes the lenders, and if they're FHA-backed loans, typically they'll push or extend the sale dates into the new year just because they don't like the bad press to have people put out in the streets or being evicted, losing their homes with the holiday season. So we typically see January as an uptick in bank repossessions. It is what it is. But interesting up though, it's up 49% from the previous month, which December is slow, so January is bigger, but it's up 70% from a year ago, which to me means there was more happening this past year than the previous year. So please keep that in mind. Having said that, they also put out another analysis from Adam Data Solutions, which is their Q1 2020 vacant property and zombie foreclosure report. So ultimately, they put a report out there. They do some analysis and they say, let's look across the board and take a look at the houses that are vacant. So they are owned by people and they are not owner occupied or even tenant occupied. They're vacant. They're sitting there doing nothing. And I guess the commentary on this is if we are in a situation where we're low on inventory, why can't we access this 1.52 million homes? Well, again, if I own a home, it's a second home, and I'm up in New York City and I own a second home in Naples, Florida, I don't have to make it available to sell it or rent it, right? If it's mine, it's mine. If I pay for it, I own it, whatever. So, I mean, this is somewhat misleading, but the point is there still is a significant amount of vacant homes which have the potential to soak up, the needed inventory for people who want to buy. So just realize that, 1.52 million single-family homes and condos are vacant, representing 1.5% of all homes across the board. Very interesting. Now, if we further delve into the foreclosure side of things, this is where it gets more interesting. So, according to the report, about 283,000 homes are in the process of foreclosure, according to what the report says, with about 8,700 or 3.1% sitting empty as zombie foreclosures. The percentage is up from the 3% in the fourth quarter of 2019. So it's gone from 3% to 3.1%, a 0.1 increase, but still, the fact of the matter is these homes are sitting there in the foreclosure process. So what that basically means is the foreclosure has been filed. Depending on where you live and how the court system works in your state, it's sort of meandering through that process. So typically these are people who either had investment properties that they're no longer paying the mortgage for. They could be second or vacation homes they're not paying the mortgage for. They could be homes that are estate homes or in probate, or they could be people that have left the homes. They're not paying the mortgage. Instead of actually sitting there and waiting to the last minute before they leave and move out, they just bug out. They want to deal with the problem. So you can drive around the neighborhood. You can see how that home looks vacant, and that's referred to as a zombie foreclosure. So it's sitting there. It's in kind of a limbo status because you can't buy it at this point in time because you want to buy it, you need to do a short sale, or if there's equity, you need to deal with the seller. But since they've left, it's vacant, it's a zombie, and you can't, and the lender has to go through the foreclosure process as per their location rules and regulations before they can acquire it and take it back, or a third-party bidder can buy it. So that's just the point. So you're going to see these properties, different locations across the country and different cities across the country, ebb and flow with respect to how many are available. And a lot of times it's investors who are looking to say, hey, I've noticed this home, I drive by it every so often, I'm going to do the research, see if I can contact the homeowners to see if I can generate a deal and take it off their hands. That's obviously something that we try to do. So again, it's just they're abandoned by homeowners that are facing foreclosure. And the commentary here is that it's certainly less than it was back a number of years ago. For me, depending on your location, they're still there, they're still available, there's still opportunities, and I think we're going to see a bit more of that happening as the year goes on. So if I go further into the report here, Excuse me. States that had the greatest number of zombie foreclosures were Ohio, Illinois, Oklahoma, and Maryland. New York continues to have the highest actual of zombie properties, about over 2,200, followed by Florida, about 1,400, Ohio, under 1,000, just under 1,000, Illinois, under 1,000, and Pennsylvania, a little over 300. So that's kind of your states. So obviously New York has a lot, and Florida, we always have them, and they're here. I guess you could say certain states or certain locations have more percentage-wise. Peoria, Illinois, have the highest percent of foreclosures, zombie foreclosures at almost 13%, followed by Cleveland, Ohio, Youngstown, Ohio, Syracuse, New York, and Knoxville, Tennessee. So I don't know, when you actually start looking at the metro level, the city level, what does this mean? Is this an economic reasoning? Is there an issue that goes along with what's happening with the local economy and the population base in these locations? I would probably assume if you do some investigation, there's reasons for that. But again, going back down to the fact that if we're in a low inventory environment, these are opportunities. You just have to work a little hard to get them. It's something that I train on. If you want more information, please drop me an email. I'll get back to you. I can show you how you can work with me on this type of stuff. All right, something came out from a website called Money Geek. America's highest mortgage delinquency rates reveal struggling local economies. So, we all know that certain major cities, have their foreclosure issues, they have their homeless issues, they have their economy issues, whatever. But what we're seeing here is that a lot of the cities with the highest mortgage delinquency rates are smaller cities, all right, across the nation. And that goes back down to, as I just mentioned, like the economic impact of what's going on in that location. Is there a major manufacturer or major job center that got closed or relocated or has gone under? So why suddenly are people not paying their mortgages on all these properties? So you take a look at it, and this again was a report that's based on June 2019 data. So it's the data that they use for this. Places like East Stroudsburg, Pennsylvania, Atlantic City, New Jersey, Florence, South Carolina, Dover, Delaware, Jacksonville, North Carolina, Laredo, Texas, Fayetteville, North Carolina, Baton Rouge, Red Stick, there you go, Louisiana, McAllen, Edinburgh, Mission, Texas, Jackson, Mississippi, Lafayette, Louisiana, New Haven, Milford, Connecticut, Charleston, West Virginia, Scranton, Wilkes-Barre, Hazleton, Pennsylvania, Shreveport, Louisiana, Beaumont, Texas, Lakeland, Winter Haven, Florida, just 45 minutes to the east of where I'm at. I can tell you that that's true. Macon County, Georgia, Clarksville, Tennessee, Bangor, Maine. There's a few, Mobile, Alabama, Utica, New York, Memphis, Tennessee. So again, you can see that certain metros, for whatever reason. Now I don't know what goes on in these metros, and these, when you look at some of these things I spoke about here, they're not top tier 1 or tier 2 cities. So something's going on in these locations that is causing a higher delinquency rate, and thus the opportunity as well too. So I know, doing some analysis and working for some clients, I know that a lot of new, we'll call them hedge funds or new real estate investment funds, are not targeting the top cities. Why? Because of the competitive nature and the cost profile of acquiring these type of properties. They're going to these type of locations because they can purchase them much cheaper and much easier with less competition at the auction or direct dealing with wholesalers or whatever, other suppliers, and they can rent them out and they're making some decent cash, return on their cash. So again, keeping all that in mind, something to talk about. So they also stress that for whatever reasons, these are the cities to keep. Metros where 90-day mortgage delinquency rates are increasing. We'll talk Bowling Green, Kentucky, Greenville, North Carolina, Dover, Delaware, Pittsfield, Massachusetts, Sioux City, South Dakota, Iowa area, Redding, California, Rapid City, South Dakota. There's a place in Indiana, Kingston, New York, Waynesboro, Chambersburg, Pennsylvania. So again, a lot of these locations not on the top list of maybe where you may move to, but people could live there, and these, we're seeing a significant change, year over year in longer or greater delinquencies. So I just say that, it's, we see the stuff in the big cities. Now we're starting to see it in the smaller cities. So that's why I expect that, very quietly, and this isn't spoken about too much, but very quiet, because we talk about existing housing sales and values going up. So values are going up, and it's being driven by a number of locations, but under the underpinning or the underfabric of the U.S., has all this going on, which will rear its ugly head at some point in time in the future. So keep that in mind. Okay, cool. And why does this make sense to participate in this marketplace? Well, Freddie Mac just yesterday put out a little note saying American housing market is undersupplied by 3.3 million units, and the shortage is getting worse every year. Freddie Mac said a report last week. New housing supply is not keeping up with the rising demand. It said the shortage is increasing by about 300,000 units a year as home builders fail to keep up the demand. So home builders can't build homes fast enough. Also, they can't necessarily build homes in where the demand needs to make sense, which is affordable housing area, all right, just because cost of materials, cost of labor, cost of land entitlement and development, all right, doesn't make sense. I mean, they're publicly traded companies. They have to earn a profit for the shareholders. It has to make sense, right? They're not going to subsidize, a lower priced home just for the sake of doing that without making a profit. So apparently Oregon is the most undersupplied state, followed by Colorado, Florida, and California. The next two states are a bit of a surprise, Minnesota and Texas, where land shortages are not an issue, but it may just be a volume and a building cost situation. So basically, more than half of all the states have a housing shortage, and the shortage is no longer concentrated in coastal markets, but spreading to the middle of the country to more affordable states like Texas and Minnesota. So there you go. The root of the problem is the housing crash and the financial crisis more than a decade ago. Many home building companies were wiped out, and that changed the sort of landscape. So a lot of they're looking at home builders as really supplying this stuff, this inventory. But what I want to talk about, because I'm in this vein of the foreclosure process, is typically what happens when someone loses their home through foreclosure, does a short sale, is they have to move. They move on. They go to rental accommodation. A lot of times it's going to multi-family, apartment complex, duplex, whatever, their condo. They're going to non-single family type environment. So what to me, what that means is the fact that then the next wave of inventory is sitting there with respect to the short sale and the foreclosure marketplace. So that's where we can subsidize this lack of inventory with existing, like it's shadow inventory. It's under the radar. It's there, but it's not accessible. That's what shadow inventory is. Shadow inventory is homes that are, and again, there's people have different definitions. To me, I look at it all encompassing. Shadow inventory is homes in the pre-foreclosure process, which means they're going to go to foreclosure and could be available via a short sale, or they've been foreclosed on and they're actually taken back by the lender, and it's in the lender's inventory as a real estate owned. Whether that comes back into the marketplace on the MLS or for the retail populations to be determined, or whether they send that off to hedge funds or other institutional investors, who knows, right? Just the way it goes. So that's the scoop on that. But I want to talk about a little bit, just because I do a lot of this analysis for some of my clients down here in my area, and I want to show you and tell you what's going on and why this is such a huge opportunity. And I've not really stated this before. I do this more in my promotional activity, but I figured, it's time to talk about this on a more global basis right now, because it is what it is. So if we step back, and if I go to again, some of my information I have earlier with respect to National Association of Realtors, all right? So the market conditions, and I always talk about, first-time buyers, cash sales investors, and distressed deals. So, out of all the property across the nation that's sold, and when I mean sold, it's with National Association of Realtors, it's on the MLS, okay? It's retail based, okay? Only 2% of the sales at any given month for the past year has been distressed sales. Distressed sales are either short sales or bank-owned / REO. So they've been taken back, they're putting out there, and they're called, they're bank-owned, real estate-owned sales. That's the distressed sales component. Only 2%. So let's just say, for grins here, that half of it's REO, 1%, half it's short sales. Right? It's actually less than 1% is short sales, but we'll just take 1% and 1%. So really, 1% or 2% of the market is distressed. But we know that there are more and more foreclosure filings happening every month, every day, every year. All right. We also know that in certain locations, the foreclosure process can take 700 days, 800 days, 1,000 days, okay, in certain states. So people have been in their homes. So you've got what's currently being filed a foreclosure. You've got what's happened last year and the year before. I can tell you there's what I call legacy foreclosures. There are still homes from the last housing crisis that are sitting there in the foreclosure process that for whatever reason aren't being foreclosed on. And there's obviously complexities that go along with that. And people are still in there, or they're abandoned, okay? They've been there for 10 years not paying their mortgage. So we have a lot of this built up under the radar shadow inventory on the pre-foreclosure side. And that's a great opportunity. Well, I call this the short sales. I call it the 1% rule. And the reason why I say that is 1% of either we see that the sales are short sales, okay, and that's it. But I could tell you that if you take a look at volume, that the filings would be way more than that. So if everybody who had a foreclosure filing did a short sale, we'd solve a lot of inventory problems. And we'd have a lot more lower price real estate too, because those would be a little more discounted. They'd drive prices down. So that's a whole other discussion with respect to controlling the market, what lenders are doing behind the scenes and stuff like that. All right, so that's another theory, all right, and concept. So I'll give you an example of what's happening here. So I have 3 counties that I'll call it my Tampa Bay metro area here, where I'm at, where I sort of look at and focus on. So, just because I pulled the stats literally 3 days ago, the active single family homes, this is not all sales, it's just the active single family houses, so single SFRs, in the 3 counties I deal with, there's just over 7,000 active sales right now. If I take that 7,000 and I ask it, well, how many of those 7,000 are short sales, I get 78. That's just over 1%. So I know that there's thousands and thousands of people who have a foreclosure filing that they're working, that are as active right now, but only 78 homes in 3 counties are active and available for purchase as a short sale, which means that nobody's hitting that marketplace, and thus the inventory is there, the shadow inventory is there, but no one's getting at it. That's the point here. All right, so that to me is a pretty big revelation. Now, if I take a look, so that's the pre-foreclosure short sale opportunity market. I also do stats on the foreclosure, so stuff that's actually been foreclosed on. So again, if I take the same 3 counties, all right, and the most recent information I had was January. I actually went through and mined the data and counted it myself, used my fingers and toes and did the whole thing here in the ladding machine. So the 3 counties I deal with, all right, had 558 foreclosure auctions that were scheduled in January 2020. And typically, as I said before, with some of the push off from December, my expectation is that January 2020 would be a more significant month for foreclosure auctions. So those auctions I can divide into 3 sections. Canceled auctions, plaintiff or lender takes them back, okay, the lender gets them back, and then third-party bidders, investor, somebody else buys it, okay? So out of the 558, 41% were canceled. So what does that mean? Well, canceled means that a lot of the people filed bankruptcy to give themselves a few extra months in there. All right, that's a strategy if you have to the last minute. They were canceled by the county or the process. Why? Because maybe they did a loan modification, maybe something else took place that sort of stopped the sale date. It doesn't mean it's never going to go to sale. It just means that it's been pushed off at this point in time. It was canceled. It may reappear down the road. So 41%, that's the highest amount of the 3 were canceled sales. The next amount, 33%, were taken back by the lender at the auction. So in other words, the lender bid and they won the bid and they took the property back. Either nobody bid against them or they bid against somebody else and the bidders dropped off, the lender ended up taking it back at whatever value that they wanted, that they did. They wanted the property back. They took it back. That's 33%. And the remainder was 26% was third-party bidders. So third parties are taking, like investors, people who wanted to buy and play in the foreclosure game, they're taking that property back. A lot of these investors are going to be, they're going to essentially rent it out. They're going to fix it, rent it out, add it to their portfolio. Some investors may just wholesale them out to other opportunists, and some people are going to buy it, fix it, rehab it, and put it on the retail marketplace. Okay, but I can probably safely say the majority of the third-party bidders are buying it for portfolio buy and hold cash flow type applications. So Take a look at that. Only 26%, if you think about it, is making its way into into the field, so to speak. But of that 26%, you don't know what's actually making its way into the retail market where buyers can access that. I'm going to say probably, just guessing, maybe out of 26, maybe 5 or 10% overall makes it into the retail marketplace. So the foreclosure process is not giving us more deals to put back in the marketplace. The lender's taking back 33%. Most of them are going to sell them as non-performing loans or assets through backdoor arrangements to other hedge funds, etc., other buyers, large investor buyers, whatever. Why can we say that? Well, because if we go to our distressed sales, when we know that the distressed sales as a whole are 2% of all sales, and about 1% are short sales, and about 1% is REOs, lenders taking back properties going back in the marketplace. So, again, not much goes back in the marketplace, all right? And because it's all behind the scene deals, non-performing assets and loans being transferred. So really, when you take a look at this, on a foreclosure situation, I'm probably thinking maybe 5 to 10% of these homes will make it back into the retail environment where everyday people, primary homeowners, will buy a property. Okay, either it's fixed up or maybe it's a little bit roughed up. I might take a gamble on it, put some more money into myself, get a rehab loan, whatever, so to speak. But please realize that the foreclosure market doesn't bring properties back into the marketplace like it used to back in the last housing crisis. That's sort of happening, been happening since 2010, 11, 12, when the hedge funds, other investor buyers really started grabbing property at the auction. So to me, this is the situation here, is that this inventory is there. We just can't access it, all right? It's very simple. Other people are taking it over or grabbing it before we do. It's not coming to the retail marketplace. So there's things that we can do. We can participate in short sales. We can go after short sale properties. We can go after homeowners that are facing foreclosure and try to work with them and acquire the homes and do that. We can also try to bid with respect to the foreclosure auctions. That's more of an investor application. It's difficult because, again, you got to have the cash. You buy, at least where I am, if you buy it today, you got to be next day at the county courthouse by noon with the cashier's check for the balance, you see, after your deposit's been taken off. So it's not really a retail, foreclosure auctions aren't really a retail opportunity, so to speak. Many times you may look at different websites that are out there, third-party websites like auction.com and Hubzu. And, I've looked at them as well too, for, I guess you could say for these have been taken back and they're being put on online auctions. They're already auctioned off at the county or the courthouse, so to speak. Now they're back in the lender's marketplace. They're not putting them out in the MLS. They're putting them on their auction platforms, their own private auction platforms. And a lot of that, they're overpriced from what I see. And again, the bidding process is not an absolute bid, an absolute auction like your auction on the county. A lot of it is reserve bids, and if you think you're the winner, they may come back and say, no, we decided not to sell it to you because we didn't get what we wanted to. We're going to put it back on auction next week. So it's a tough kind of market to be in. But ultimately, in the end, that's sort of what I wanted to discuss. Is I'm trying to open this up to more people to learn this, to participate in both the short sales and the foreclosure auctions, and also, as I mentioned, my turnkey investment strategy and service. So I'm not really selling you anything here. I'm just explaining what it is. If you'd like more information, email me directly. We'll talk. I'll tell you the criteria. But for example, turnkey investment strategy and service. Funding source. I've got funding sources. You have to have a little money down. Okay, it can't be 100% virtual money. Okay, you got to have a little bit down, but funding sources if required. We can locate the investments, evaluate the investments, help with the acquisition process, acquire it through my channels. All right, we've got property insurance set up. We've got the property rehab, contractors, handyman, whatever, the management process of that down. Tenant acquisition, we can help you acquire the tenants. Property management, we can refer that out, and we can have people help you manage the property if that's what you need. Property sale, if you want to fix and flip, or you want to flip it to somebody else, we can do that with you and for you. Legal support and title services. I've got attorneys available who are very good at this, and we have title companies that work with us, of course, which is great. So again, something you want to talk about, drop me a line, an email, let me know, give me your name, information, and your phone number. I got to be able to text you, okay? Also, with respect to, I think this year is going to be a big year with short sale opportunities. 1% is not much, and I can tell you Back in the day, in the last housing crisis, over 50% of the MLS were active short sales. So we've gone from 50% to literally 1%. All right, and I expect that we're going to see a lot more of that happening right now. The foreclosure market is changing. I know people always think they can stay in their home for 3-4 years. That is changing. Stuff is speeding up. The court systems are different. Lenders are more prepared, and if they take it to foreclosure, they know they can. We're not going to have any more of these 10-year, 5-year issues. If they file it, they can take it back. They're confident they can do that. The court has new conditions that they can't play the game. They got to prove the documentation and go through with it, and they will. So that's a scoop for today. I think there's a lot of great opportunities there for this year and more coming up. So drop me a line. So once again, thank you for the views. Thank you for the comments and likes. Please share the video with your family and friends. Help my channel grow. If you're not already a subscriber, please click the subscribe button on the bottom right, and that would be most appreciated. We look forward to speaking with you later on. Thank you.